Hello everyone, this is chapter 11 part 1. In this part we'll be talking about technology, production and costs. This chapter is basically the foundation if you will of what we'll do for the rest of the semester. So chapter 12, 13, 14 and 15 will be based on this chapter. So I want you to take a look at this little photograph of workers working in a factory. So technological change, the caption says, leads to new products and lower production costs. How do firms take costs into account when setting prices? So this chapter will be all about costs in the short term, and in the long run we'll learn about technology. Let's get started. Here's the little GPS for chapter 11. First, we will define a technology, and next we will talk about short run and long run in economics. So we'll distinguish between economic short run and economic long run. Let's get started. Technology. When you say technology, I'm pretty sure the first thing that comes to your minds is your laptop computer, your smartphone. This is the smartphone. So when I hear the word technology, the first thing that comes to my mind is my computers, my tablet, my smartphone, and all those tools that I use. But in economics, when we say technology, we mean something else. We actually define technology as the processes a firm uses to turn inputs or factors of production, remember labor, we talked about capital, so the processes a firm turns inputs, capital, labor, land, other resources, we learned about these, into outputs, whatever they're producing of goods and services. So when we say technology, we are not really talking about these technological machinery tools per se, but we're talking about how you put them together. For instance, Texas A&M Corpus Christi, yes, is a university. It's a public university, but still it is a, so to speak, it's a company. I don't want to say company. It's not a for-profit company. It aims to maximize education, but still it's a firm that uses different inputs or factors of production. It puts professors is the labor component of production at Texas A&M University Corpus Christi. Buildings are the capital component, computers and equipment capital component. So for instance, the computer tablet the university gives me so that I can record my classes would be an example of the capital component. My office would be building. So you combine them, so you put all these. I put a blender here. Obviously the university doesn't put professors' buildings in a blender and mix them. I am trying to underline the fact that we choose certain levels of inputs. For instance, you are assigned to one professor per course. Each professor has an office, and each professor has certain number of each professor has access to a certain number of computers and equipment. So technology here is really this like blender. Obviously we don't put them in blender, as I said, but you combine them in certain quantities and then you get output. What is output here? At universities we are producing education, or knowledge is the output. Obviously that's not tangible, so we're not making apples, we're not producing apples, bananas at university, but we are hopefully producing something more valuable. So this blender is the technology, really, how you're combining these inputs. Okay, technological change, what does that mean? Technological change is defined as a change in the ability of a firm to produce a given level of output with a given quantity of inputs. So most of the time we experience positive technological changes. In that case, an example would be, for instance, a way of arranging the store such that you let's say arranged your ice cream stores such that your sales has gone up. That would be an example of a technological change. Let's take a look at this example, improving inventory control at Walmart. This is making the connection example. So Walmart has adopted better inventory controls, and what happened was that these inventory controls and the stock room, inventory rooms, organizations helped reduce Walmart's cost. That's an example of a positive technological change. Okay, you didn't change anything per se. Probably you're hiring same amount of people, you have the same number of forklifts or shelves, okay, but how you do things could be changing the way you actually conduct business could be an example of technological change. So at Walmart, improvements in inventory control meets the economic definition of positive technological change. Why? Because they allow firms to produce the same amount with fewer inputs or produce more with same amount of same input. So if you were to use same number of workers, you will be able to produce more. So if you remember chapter 1, we talked about certain assumptions, behavioral assumptions. We said that individuals are rational and they're trying to maximize their utility, and companies are trying to maximize their profits. We need to make a couple of more assumptions on production. Number 1, production we assume is efficient. So if you imagine we are on our production possibilities frontier, okay, so maximum output is being produced using minimum input. This is very strong assumption, but we're going to go with this assumption for now. Second assumption is at least one input of production can't be changed immediately. So the example could be if you worked at a restaurant. Okay, how fast do restaurants hire and fire workers? So labor component. How fast? Think about it. Let me tell you, I worked at a restaurant and it is immediate. If you want to fire somebody, you just, show them the door. Or if you want to hire somebody, if you need somebody, you found the best person, you're hired. You can start, okay? It's that fast. However, capital adjustments take time. Capital adjustments take time. For instance, let's say a restaurant is trying to increase the restaurant space, so it signs the lease. Okay, forget that. So let's say the restaurant's business is booming. Forget about what I just said in a second. Okay, let's say the restaurant's business is booming. Boom. Okay, then the restaurant decides to buy many more ovens. Okay, to cook. Let's say this is a pizza restaurant, to cook more pizzas per hour. So when the restaurant orders these ovens, these are not like the regular ovens. Obviously, it's going to take time to order. Number 2, shipping is going to take time, plus installation is going to take time. So capital, we say you can't really adjust capital really fast. So let's define an artificial time construct for this to convey the idea that at least one input can't be changed immediately. In economics, we divide the time in the short run and to the long run. So imagine like every company has a short run. It's a period of time at least one input can't be changed, and long run is a period of time you can change everything. So short run is a period of time during which at least one of firm's inputs is fixed. So if we're talking about labor, which we use L to denote, and capital, which we use K, right? In the short run, we assume that capital, like those ovens, are fixed in the short run. Okay, that means short run is a period of time in which you can't adjust your capital, and labor is variable, that means adjustable in the short run. Long run is a period of time in which a firm can vary all inputs, adopt a new technology, and decrease the size of its physical plant. Size of physical plant means, you turn a Walmart into a Walmart superstore, which are much bigger than regular Walmarts. In the short run, therefore, you can fire new people, but in the short run, you cannot change the technology level, you can't adjust your capital. Just be careful, short run is not a set period of time. So short run of each firm, it depends how long the short run is going to last, depends on the company or the firm. Okay, if a company can quickly change its capital, then we say its short run is relatively shorter. Okay, this concludes our part 1.